back. Aloha. I just got back from the island of Oahu, so I'm back at it. Good little R&R for the week. It was an interesting trend that was kind of bucked the trend. I've been to many vacations, but the market went down a lot when I was on vacation. It was kind of this weird thing that always kept happening. But this time, no, we had a pretty bullish market over the last week, and we continue in this choppy pattern for the year overall. And I think it is something we should expect. There's still a lot of crosswinds from a higher interest rates that are having impacts across interest sensitive parts of the market, like real estate, like technology stocks, commercial real estate, more than residential real estate, but certainly having an impact on car loans, anything people have to borrow money to do. And so that's an interesting trend. And then you have liquidity that is improving. I know it sounds weird, the Fed's raising rates, but the liquidity has pretty much improved since October. So it's not always the headlines that you want to pay attention to, but really those liquidity trends. And that's what you're seeing right now is still liquidity that is once again improving. So that's what's happening so far this year. We're 3.5 months into this year, and it goes by quick. And there's a lot to unpack, and that's what I'm going to do for you today is really dig into the economic and geopolitical trends that we are seeing. This kind of plays into the fourth turning. Our main focus point is certainly ties into that changing of the guard, as you say. And there's a lot of hyperbole that's thrown out there. And I want to do my best to get rid of that. Focus on kind of the gray area. So many people, especially in a hyper-politicized environment, they try to make everything black and white. It's either left or it's right, or it's horrible or it's great. And the reality is most things are a bit in the middle. And that's what we're to help you do, is try to help you parse out what is hyperbole, what is fact, what is real, so that you can make good money decisions. So I'm Justin Klein, and I'm excited for this radio program and podcast to answer your finance and investment questions and do that in a straight and unbiased way, as always. No hidden agenda. And so we've talked many times about this changing market environment and how this is that time, that fourth turning, where times are tough. We all feel that. We all feel the angst in the air of what's around the corner. What's the next major problem that's going to arise? And how do you react to it? How do you make smart decisions that provide successful outcomes based on what your risk tolerance level is, what your goals are, etc. So I encourage you to reach out with your finance and investment questions. As always, our anytime listener line is 888-99-CHART. Now, we've got a lot of material to cover for this podcast. One is in regards to de-dollarization. How real is it? What are the headlines? Headlines talking about China and Russia and Brazil and all these countries that are starting to try to trade in other currencies. And does that mean the dollar is imminently in peril? Or is it something that's overblown? The reality is probably in the middle, like I said. So we're going to dig into that, and I'll give you my assessment of what it means and what good can come out of it and bad. There's two sides of it. There's always two sides. Just like having the world's reserve currency, there are two sides to that as well. There's positive and there's negatives. So we're going to dig into all of that, as well as a few other things. One is in regards to the bond market turmoil and turbulence. And I want to dig into that because asset prices across the board are really tied to the 10-year Treasury, for example, the Treasury market rates. Just look at mortgage rates now. That's tied to the 10-year Treasury. And so it's not just mortgages, not just real estate, it's other asset classes as well. So when volatility perks up there, that creates volatility elsewhere. So we're going to look at that. Also, options are very popular. Buying and selling options. How liquid? What's the cost of trading options? And there's some data on that. And then lastly, the US is kind of cracking the code when it comes to Bitcoin and crypto and seizing funds. And what does that tell you about how well prepared the government is becoming in kind of fending off the crypto networks from being a part of the real financial system? So we're going to look at that. Now let's take a look at we have some other topics as well in regard to some voice bank questions, lending club, as well as a money market fund that we had a call about. And then we have an excerpt from the newest KPP Premium newsletter that's coming out tomorrow morning, as well as your live calls as well, which we're going to get to at 888-99-CHART. Let's take a quick look at the markets today before we get to our first caller. It was it was modestly negative. S&P was only down 8 points. Pretty modest there. So it was kind of a flat day going into the weekend. And overall, it's been a bullish kind of consolidation period over the past week and a half, 2 weeks or so. And not a shock. As you have cooling inflation, better liquidity, and a more dovish Fed going forward, which it looks like. So markets are certainly liking that. Now let's go to our first listener question, and is Nick in Manhattan. He's looking at MP Materials.
Hi, Justin. Happy Friday to you. I am calling about MP Materials Corp. It's an operator of, I think, the only rare earth mine in North America. It's about 50 miles south of Las Vegas, and they make they mine rare earths that go into magnets that power traction motors in electric vehicles, robotics, wind turbines, sort of green technologies. And as you know, the Biden administration is definitely behind this effort to transform the economy. Recently, the EPA released rules that are essentially going to force all the car makers to be predominantly makers of electric vehicles instead of internal combustion engines. And these sorts of vehicles and technologies in general, like wind turbines, they need these rare earths. And historically, most of them have been sourced from China, but we are not big fans of China these days. And so I think that there's, much like the Greenspan put under the market in the 90s, I think there's a Biden put underneath the American supply of raw earth minerals, copper, stuff like that, and neodymium, which is found in this mine. So I'm bullish on this company long term. I've been watching it for the past year, and I think that the recent EPA rules are a catalyst for a price rise. What do you think about that?
Yeah, I certainly understand your sentiment and that kind of narrative there. The issue I have is just technically, it remains in a downtrend. There's really nothing that's showing me that this is breaking out to the upside. It continues to underperform the broad basic material space as well as the market as a whole. And that's my biggest worry here is I want companies that are outperforming the market, outperforming its peers, and this just continues in a downtrend. Now, long term, yeah, you're right. There's going to be more demand for rare earths. Now, I think rare earths are a bit of a misnomer. They call them rare earths. Some of them are not really that rare. A lot of them are not really that rare. Now, the good thing is, like you said, this is the largest one in the Western Hemisphere. And as you have geopolitical tensions, certainly this could turn out to be one of the rare sources of rare earths for domestic battery production, et cetera. So I certainly have been keeping an eye on it. This is a name that I've always kept my eye on It was pretty overpriced when it was about $50 per share early last year. Now it's down to about 28, and it's more reasonably priced. I think it's probably fair price now. I wouldn't say it's cheap. I wouldn't say it's super expensive, but I would say it's fairly priced. The issue, though, is if it's fairly priced, I want at least some good price momentum to the upside, saying it's going to start to improve from there. And I don't see that. So certainly a name, once again, on the watch list, but the technicals really need to line up. And there's really nothing on the technical side that's telling me to go out there and buy it right now. I would be looking for some sort of capitulation volume. You had a bit of a big sell-off about a week ago on decent volume, but nothing that's really extreme. You saw one back in July of last year, and that marked a short-term bottom, but rolled over rather quickly. So I don't like the series of lower highs and lower lows, and I don't see capitulation volume quite yet. So still on the watch list for me, not ready to jump in quite yet. But I agree with a lot of your sentiments, Nick. Thanks for the call. Now we're going to a quick break. Please remember that you can call anytime and leave your question on the InvestTalk voice bank. Or if you're listening via our live stream, you can call right now on 888-99-chart.
In today's world, a variety of factors are affecting the stock markets. Serious investors know building a secure financial future requires hard work and determination. That's why now, more than ever, when it comes to the planning, execution, and maintenance of your portfolio, you need InvestTalk. With total downloads surpassing 50 million, each InvestTalk podcast should be one of your key financial planning and educational tools. InvestTalk is a free download, and hosts Justin Klein and Steve Peasley stand ready to provide their unbiased guidance and professional analysis developed from real-time data research and years of investing experience. 24/7, rain or shine, during smooth sailing or on rough weather days. The InvestTalk listener line is open and waiting for your questions. You set the agenda. Don't forget to call InvestTalk 888-99-CHART.
Justin Klein and Steve Peasley are ready to take on your finance and investment questions. So don't forget to call InvestTalk 888-99-CHART.
Let's go talk to James. He is in New York looking at, is it CLFD?
Yes, Clearfield Incorporated.
Okay. What do you know about the name? You looking to buy it, sell it?
I'm thinking of buying it, and I have maybe for a short term, like a trade. I know it's plummeted quite a bit. It's been trading sideways for maybe the last month, it looks like. And I'm thinking maybe if there's some upside potential in the near term. Just wanted to hear your thoughts on that.
Well, let me give you a quick primer on charting here. And when you see something move down and then chop sideways for a period, like you said, about a month, it's been chopping sideways in the mid 40s. It's just gaining steam to move lower. That's what we call bearish consolidation. It did this back in the beginning of the year, where it fell in early February, consolidated pretty much the entire month into early March, and then had another leg lower from the low 60s all the way into that mid 40 range. And it looks like it's just trying to do that once again. So I would pass on this as a short-term trade. This looks bearish to me. I see no exciting upside for this stock in the near term. I know you're looking at probably it looks cheap, but cheapness is not a catalyst for a trade. The technicals are. Analysts continue to downgrade earnings going forward. So I would not be buying this as a trade. Maybe a good short. It's actually a pretty good near-term short candidate. Thanks for the call. Now we're going to take a break. And on the other side, we're going to talk to some more caller questions at 888-99-CHART.
One of the most rewarding things I do each weekday is host the InvestTalk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. You, the caller, get to chart the course for each InvestTalk podcast. Call with your questions anytime, day or night, 888-99-CHART.
Now, my focus point today looks into the story behind this question. Is the threat of de-dollarization real? And there have been a lot of headlines lately about China and Brazil reaching an agreement to settle their trade in each other's currencies. And over the past 15 years or so, China has replaced the United States as the main trading partner for Brazil. And it's not a shock because Brazil is very resource rich. And China needs resources, just like Russia is very resource rich. Make natural trading partners from an economic standpoint. Now, from a political standpoint, very different countries. China and Russia, for example, they have been historically rivals and enemies. So historically, not typically a partnership that is fruitful for either side. But in the near term, there are many countries that are starting to think about how to diversify away from the dollar, which is essentially the default currency for international trade and a global unit of account. Think of everything that you get a price for. You don't say this is a certain amount in rubles or in yen or in yuan or in euros. Maybe in Europe you might do that, but for almost everything, it's like, for example, Bitcoin. You don't say what is Bitcoin's price in these other currencies. You say what is the Bitcoin price in dollar terms. And so it's just the standard unit of account across the globe for the most part. And that's why central banks park their money in treasuries, and most central banks have their foreign currency holdings in U.S. dollars, mainly in dollar-type assets. Now, the fact that we have weaponized the SWIFT system, the dollar system, against enemies like Iran, like Russia, that's forced them to look for alternatives. And that's what the impetus kind of near term is for this. If, for example, we lifted those sanctions tomorrow, there would be a much, they would go back to using the dollar pretty quickly. And the reason is because there's just a network effect there. Countries want to trade efficiently, effectively, economically, and the dollar system, and especially not just the dollar system. Everyone thinks about the dollar system here in the U.S., but there's what's called the euro dollar system, which is trade and economic activity that's happening outside of the country. Everyone thinks of euro dollar, and that's the Europe. No, it's just anything that is foreign. Okay, foreign dollar system around the world. And over the past, since the financial crisis, obviously the Fed has had some unpredictable policy. Same with COVID. The government policy has been very frenetic and unpredictable, and certainly there were a lot of mistakes made with COVID. So I think from a political standpoint, there's just been a lot of mistakes, put simply, over the past 20, 25 years or so, that has caused a lot of these countries to think about a different way of doing business. Now, that's kind of the negative, but in reality, we're kind of still the cleanest dirty shirt out there. And if you look at currency pegs, for example, still 22 foreign central banks and currency boards peg their currency to the dollar. Even China pegs the yuan to the dollar. Okay. And so the question is, how do you usurp that system that's been in place? And a lot of the system isn't something that we created, right? The U.S. didn't create this euro dollar system. Certainly the petrodollar system is a big part of that. But the trading mechanisms and the infrastructure around the world that utilizes dollars is something that, for the most part, we didn't create. It's countries that don't have central banks that are as responsible as ours. And you could say ours isn't very responsible. Like I said, over the past 20, 25 years, probably not. But before that, in many ways, we were more responsible and still remain more responsible than many of the other countries that are out there. So the big question isn't really about what currency will usurp the dollar. It's more about, will there be a shift, and it will be more a regional currency, or will it be something like a basket of currencies? That's what this special drawing rights of the IMF use. They use a basket of currencies. It's going to be something like that. Will it be backed by hard assets like oil, natural gas, gold, silver, copper, etc.? That's certainly a potential. And I think that's really what it comes down to is there's always going to be a future, right? A different reserve currency that's used throughout the world. And the dollar will be usurped at some point, but it's likely going to take many years to create the systems that replicate a lot of the functionality of the dollar system today worldwide. And so this is more of a generational shift that's probably going to take 10, 15, 20 years. And also, the big question, the other question you have to ask yourself, is it really good to have the dollar as a reserve currency? Because what happens is, if there's just a gradual downtrend in the dollar, that's actually generally going to be good for the most part for the U.S. because our exports are going to become more competitive. Right now, that's one reason why all of our jobs are being shipped overseas, because we are the reserve currency. And we have to export dollars. We have to have a negative trade balance. So after the break, I'm going to dig into a little bit more of what could come next. All right. And then after that, we're going to talk to Sergio from Pennsylvania. So hang on. You'll be next on InvestTalk at 888-99-CHART.
So, how does it feel when you play Roll Up to Win with Tim Hortons? Buy a hot or cold beverage using the Tim's app and find out. Roll in the app for a chance to win prizes ranging from free coffee and donuts to a Universal Orlando resort vacation or a sweet car. Oh, don't forget the TV. And this year, every roll is a shot at a $1,000 daily giveaway drawing for two $500 prizes. Roll up to win and get treated by Tim's. No purchase necessary. Account registration required. 50 U.S. and D.C. 18 plus entered by 4/2/23. See rules at rolluptowin.com for free entry or full details. Void in Florida and where prohibited.
Wireless headphones. That'll be $200.
I'll use my Capital One Quicksilver card.
Now that's a hit. You used the Capital One Quicksilver card, which makes you the hero of every purchase. With Quicksilver, you earn unlimited 1.5% cash back on every purchase everywhere.
I wanted running music, but unlimited 1.5% cash back is pretty heroic.
Good instincts. Every hero needs a theme song. The Capital One Quicksilver card. What's in your wallet?
Terms apply. See CapitalOne.com for details.
To my newborn baby boy, the day you arrived was one of the happiest days of my life. Right up there with the day I bought my RV from that guy on the internet and insured it with Progressive. What a deal. Just know, son, I'll always be here for you. And by here, I mean in the middle of absolutely nowhere. In my RV.
Protect your baby with an RV policy from Progressive. Take as little as 4 minutes to see what you could save at Progressive.com. Progressive Casualty Insurance Company and Affiliates.
Justin Klein is here and ready to take your calls live. InvestTalk, 888-99-CHART.
Let's go talk to Sergio from Pennsylvania. He wants to talk about target-dated funds.
Yes. Thank you for taking my call. Really enjoy your show. My question is, if I have a target-dated fund, and let's suppose that there is a foreseeable recession or increasing interest rates and that kind of thing, how often does the manager of the fund change the portfolio?
Well, that's one of my big problems with target-dated funds is they don't do anything like that. They don't make changes in regards to what's happening in the economy, what assets are cheap or expensive. They're on what's called a glide path, and the glide path is what it is, right? They might change that methodology here or there, but that's something that's very rare, and it's not going to be impacted by what's happening in the overall economy. So, for example, if you're in a long-term target-dated fund, a 20-60 target-dated fund, for example, you're going to be almost entirely in equities, and a lot of them are just indexing, so they're going to be weighted towards the growth side of the market. And so if the equities go lower, they're not making a change, not really making a change. It's still very long-term, and they're not buying or selling or making any major changes because of what's happening in the market as a whole. They, maybe monthly make a small change to getting a little bit closer to that target date, and they may sell off, a very small percentage of equities, and that might be at a good time, it might be at a bad time, and so it depends on what that glide path looks like. But no, it's none of them that I've ever seen take into account what's happening in the broader economy or the market as a whole. Does that make sense?
Yes, it does. Now, if I am like a 57 and my money is at Fidelity, if I want to work with your firm, in that case, I have to wait until 59 and a half in order to move the money to you?
If it's in a 401k, you don't. Yeah, exactly. If you have an old 401k, you can roll that into an IRA, and then we can handle that. But if it's in a 401k that's active, you're contributing to, 59 and a half before you can do an in-service rollover into an IRA.
The same thing with the 453 and
exactly. Yeah, all of those. If they're currently active, you're contributing to them. You can't do an in-service rollover until 59 and a half. After 59 and a half, you should be able to roll it over into an IRA. Still contribute to it if you're still working there. But until then, it's kind of unfortunately stuck within those targeted funds or whatever your options are at your firm.
Thank you very much.
No problem, Sergio. Thanks for the call. Now, before the break, I was talking a bit about the shifts and how the dollar over time is likely to lose its reserve currency status. But it's not going to be like people think it's going to be the yuan. No. And I think that's very, very low chance that's going to happen. First, the yuan is currently pegged to the US dollar, and it doesn't float. It means it's not subject to market forces. One of the big reasons why people or the world uses the dollar is because it is subject to market forces. It floats. And this peg that the Chinese authorities use to keep the yuan from going higher, it's to benefit Chinese exports. They're manipulating their currency in order to keep the yuan lower and therefore benefit their main part of their economy, which are exports. Now, the Chinese capital account is also closed, which means that money isn't free to flow without the government's approval. So people are saying, the yuan's going to be the next reserve currency. I find that highly, highly unlikely, okay? But once again, it could be part of a basket of currencies as well as harder assets that is used more globally. And so that's certainly a possibility. So once again, the prospect of anything happening in the short term, days, weeks, months, even a few years, that's not going to happen. It's virtually impossible for the dollar to be usurped in that short of a time frame. Why? Because of the depth and breadth of the U.S. economy. First of all, a lot of people hate on the U.S. economy, but the diversity of our economy is second to none. We have diverse commodity base with obviously our energy and shale drilling. We have a lot of natural resources from copper to uranium to all types of hard assets throughout the country spread out. We have obviously technology sector that's very strong, a finance sector that's very strong. There's a lot of our sectors, industrial sector that is maybe not as strong as it used to be, but is still relatively strong against the rest of the world. So we have a very, very diverse economy as a whole. And we still are the largest trading partner with the vast majority of countries that are out there. And so there's a high barrier to exit. There's a lot of switching costs to move away from the dollar for a lot of countries. You notice that all the ones that are doing this are the ones who trade the most with China. But is China going to be able to, with their demographic issues, remain that 10, 15, 20 years from now? Unlikely. Okay. So the more pressing issues for us has more to do with what's happening at the government level. How sound of a fiscal and monetary policy will we continue to have so far over the past, especially since COVID? Not very good. I think that's a big aspect to this that's underappreciated is that, hey, yes, it's our currency or our weaponizing the dollar system and those sanctions that we're putting on our enemies, but it's also kind of us fumbling the bag over the past few years in a big way. And but like I said, it's really the payment system. 95% of the world's dollar payments are settled via SWIFT, our interbank system that we have control over. Okay, and so over time, this could shift, but also over time, like I said before the break, this actually can be a good thing. Mild depreciation will help U.S. exports, will help us rebuild our the Rust Belt. That's why there's a lot of political divide in this country, those that are a part of the Rust Belt and those are more on the coast. And a lot of that has to do with the hollowing out of the center of the country due to us having too strong of a dollar, right? That's being propped up and us exporting our production overseas. And now that's coming back. And a lot of that is positive and hopefully will bring more union to the country. And that, I think, is a potential good side effect of the dollar becoming less of a reserve currency overall. So it's two-sided. You have to look at it both ways. And like I said at the top of the show, the reality typically lives somewhere in the middle. It's not the end of the world. And it's also, the dollar's not also going to be the reserve currency forever. All right, let's go to Bob in Palm Desert looking at TRTN.
Hi, Justin. Thanks for taking my call.
Sure.
I own shares of Triton and have for a couple years now as a long-term play in a balanced portfolio. And this week they were the target of a acquisition, and the stock shot up quite a bit. And I just wanted to know your take because apparently the company is being taken private. And I wanted to see what your take is, if I should just sell and take the profit at this level, or what do you think about holding it and what I should do going forward?
All right, so they are being bought by Brookfield Infrastructure Partners, and it looks like it's going to be cash and Class A shares of Brookstone Infrastructure Partners LP. So BIP is the symbol of that. And so you're mainly going to get cash. Let me take a look at the price here. About $85 per share. What's it trading at now? Yeah, 83 and change, 83.50. Typically these take some months to kind of finally settle out. And then also you're now going to have some correlation with BIP because the deal, which if it goes through, which it probably will, you're gonna get some amount of shares in BIP. And so this will fluctuate a little bit with the BIP shares. Obviously, the vast majority it's cash, so that's pretty solid. So there's the question is, do you want to own BIP? Now, it's a limited partnership, so it does pay out a dividend. That's going to be taxed at your ordinary income tax rate. Do you want to own that? So that's something to think about as well. I would probably just take the money and move on. You made a good buy. Are you close to long term on this name?
Yeah, it's a long-term capital gain for sure.
Yeah, so you're taking long-term capital gains. I would just move on. You're talking about a little bit potential upside, but not much. And you could go and reinvest that money into something that has much higher upside. So you're going to be forced to take these gains. Now, the good thing is if it's turned into stock, part of it's turned into stock, that you don't have to trigger those long-term capital gains. So I think that's something to think about, that you're not triggering this, 20% of the deal that's going to be in stock. But 80%, you're going to be forced to take those gains. So it's a small percentage of what you're thinking about there. I would just sell it and move on and try to find something that has a better upside.
Yep, that's what I was thinking. Thanks so much, Justin.
No problem. Thanks for the call. Now, the KPP Premium Newsletter was finished today and will be distributed to subscribers tomorrow morning, and I have a preview. Now, in the market conditions section, we explained the market participants were in a wait-and-see mode this week as they anticipated the release of the CPI data and some key earnings from some of the nation's largest banks. Now, midway through the trading day, the S&P 500 was poised to finish the week about a 1% gain. And the March CPI reading was released early on Wednesday. Year-over-year inflation eased to 5%, down from 6% in February. Core CPI, which excludes energy and food, rose to 40 basis points in March, bringing it up to 5.6%. Market expectations are still on the side of a 25 basis point hike in May, with Fed futures signaling an 80% chance of a hike. JP Morgan Chase, nation's largest bank, saw profits drop 52% with to a record level for the first quarter of the year. Revenue growth was at 49%, and mainly because of higher interest income. And they reassured investors on the regional bank crisis to not spread to the nation's largest banks. In fact, they actually benefited. Now, a mild recession is still a real possibility, and it is clear that the downside trend in inflation and loosening of the labor market over the past several weeks, that the Fed is beginning to see the side effects of the most aggressive campaign to raise interest rate in decades. And there are still several events on the horizon that investors should be aware of, including the possibility of a deeper than expected earnings recession and a prolonged battle over the debt ceiling. And we dig into more of the commentary in the newsletter. We also highlight a few stock ideas. One is a leading financial services company that has a strong track record of stability and growth with a long history in the financial industry. It has been established itself as a reputable and trusted brand, serving millions of clients and managing trillions of dollars of assets. Price stabilized recently around $50 per share with a PE of only 14 and a 2% dividend yield. And upcoming earnings should clarify the impact of recent financial fallouts in the sector. We also look at a leading utility company with a strong presence in the Midwest, has a 3.35% dividend yield, and we name names in the newsletter. You can subscribe over at InvestTalk.com. All right, let's pivot and talk a bit about. All right, we're going to grab a listener question now.
Hey, Steve or Justin. My name is Danny, calling from New York. Longtime listener. Really appreciate everything you guys do. I had a quick clarifying question on Lending Club. The other day, you guys had a caller question asking about their high yield savings account. And Justin mentioned that they are not FDIC insured, in which case, they would obviously pose quite a bit of risk. I actually have a fair amount of cash parked with them, and my understanding is that they are FDIC insured up to $250,000. So I was wondering, where you were seeing that they are not FDIC insured, and what I might be missing here. Thanks in advance, and look forward to hearing your response.
All right, so I've got a couple emails on this, and I was not aware that Lending Club does offer an FDIC insured offering, but not all of their offerings are FDIC insured. So that's what you need to understand, is that it's just because it's at Lending Club does not mean that you are FDIC insured. Now, they have FDIC insured options, but they aren't. All your money there isn't FDIC insured unless it's just in that FDIC insured fund. Okay, so there are a lot of investing options. You're going to get higher yield if you're getting 7, 8, 9+% yield over there. That's not FDIC insured. Anything that's FDIC insured is going to be kind of around the market rate, 4 or 5%. So it just depends on what offering that you are in. And once again, I wasn't aware that Lending Club had moved into offering those FDIC insured deposits, but I guess they have. So make sure if you have money over there, you know exactly what it's in. Not everything at Lending Club is FDIC insured. Now, this is InvestTalk. I'm Justin Klein, and we have one goal here, is to help you achieve your own version of financial freedom. And we are heading into our final break. So if you're going to call, you want to do that right now. And after the break, I'm going to touch on the bond market. And I know it's boring, but it's vital to understanding what's happening in the broader financial system and how that feeds into the economy as a whole and different asset classes. So something that I continue to watch each and every day, and I want to give you some statistics and what you should watch to make sure you are on top of it. All right. So get your questions in now at 888-99-CHART.
No two portfolios are alike, and every investor has a unique set of circumstances. So don't forget to call InvestTalk, 888-99-CHART.
Now, before the break, I touched a bit on the U.S. bond market and the Treasury market, and this is really where the rubber meets the road for the economy as a whole. And during the recent banking crisis, there was a lot of volatility in especially the 2-year Treasury. It averaged 0.22 percentage points from March 9th through March 27th, so almost the entire month of March. And that's a lot of volatility for a market that tends to be pretty stable. And this was the most volatile stretch since the early 80s. Remember when rates were in the teens? And the moves since then, though, have mellowed out to about 6 basis points, right? From 22 down to 6 basis points. The average one-day change in the 10-year yield also shrank to about 0.4% from about 0.12%, from 12 to 4 basis points. And that's overall a good thing, because when Treasury yields were jumping all over the map, it was hard to price things like corporate bonds. And corporate borrowing came to a standstill during that crisis, not just because of the uncertainty of what's going to happen with Silicon Valley Bank and the other banks, but really that volatility within the Treasury market. And so, people that manage companies, they're human as well. And so they want uncertainty. They want certainty. And the certainty is, what's the cost of this debt going to be? And when you're working with an investment bank that's taking these bonds to market, if there's a lot of volatility in the base rate, which is that 2-year or that 10-year rate, that can provide a lot of uncertainty. Okay, am I going to be borrowing at 5.25, 4.8? 5.7, what is my borrowing cost going to be once this finally gets to market and it's priced? And that volatility creates a lot of issues. And so over the last few weeks, investment grade corporate issuance has gone up dramatically. You had $15 billion coming from Marriott, Pacific Gas and Electric as well. You also had Ford and Cloud Software Group. They issued $8.3 billion in junk bonds. And so this is the second highest weekly tally since the start of the year. And this is important. This is why that stability within the bond market is vital. And that's why I tend to watch the MOVE index. And I've talked about this before. And it's really the VIX of the bond market. And this was above 150 for most of that time when there was a bunch of volatility within the Treasury market. And now it's sank back below 120. That's 118 right now. And that is a good thing. That is positive. That is bullish, because that's stability. That creates more liquidity. That means banks are going to lend and people are going to borrow, or corporations are going to borrow, because they have certainty to what's happening. What their costs are. Okay, so I wanted to just highlight that, because it's very important to keep an eye on that volatility. And if that perks up back again, that's going to be bearish for risk assets. Let's go to Robert in Pleasanton, who wants to talk about Yieldstreet.
Hey there, Justin. Hey, thanks for taking my call. Just kind of looking to possibly diversify my investments and get something outside of the stock market. I've been looking into Yieldstreet. I was just wondering if you had any opinion about them.
Well, Yieldstreet is just a private REIT that's sold online. That's it. There's really no difference there. They advertise it as alternative investments, but they invest in commercial real estate, and obviously commercial real estate is having a tough time. And so that's the biggest issue here, is that there's Fundrise, there's Yieldstreet, there's a lot of these online private REITs that are just marketed, instead of through some sort of seminar at a hotel, they're just marketed through online platforms. And it doesn't make the underlying asset really any different. It doesn't make them managed any better. And they haven't really been through a down cycle. A lot of these are relatively new. So who's the manager behind the actual private REIT that you're investing in? Because that's what you're investing in. Excuse me. And right now you see real estate assets, anything non-residential is struggling. Now, there are parts of commercial that are still doing well if they're located in Texas, etc. But overall, you don't know what's in them. You don't know really what type of risk you're taking. You don't have any track record of a down market and how well they've done. So I don't see it as a good place to be because I don't have much clarity, and neither do you, of whether these are good or bad investments. And a lot of them are marked to whatever they feel like they want to market to, right? The assets, the value of the underlying assets. So I would pass on something like Yieldstreet. Thanks for the call. I'm Justin Klein. This completes another InvestTalk program. Steve Peasley and I thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play, and be sure to rate and review on iTunes as well. And remember to follow InvestTalk on our social channels and like and tag us as well. Independent thinking, shared success. This is InvestTalk. Good night. Enjoy your weekend.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights. For more information regarding KPP's investment advisors, call 1-800-557-5461. Steve Peasley is president, and Justin Klein is chief executive officer of Klein, Pavlis, and Peasley Financial.